All right, good deal. We've got Jim live, and Jim, I'll put the timer up there, and for the next 30 minutes, the room is yours.
Okay, thank you very much, Morgan, and welcome everyone here to the webinar. By way of introduction, my name is Jim Kinney, and I am the content provider for the optionprofessor.com information that they have and the DVDs that they have. Just a quick background on myself. I'm a graduate of Boston College, and I went to the Options Institute at the CBOE many years ago for advanced options training, and I've been doing seminars throughout the nation for about the last 25 plus years. So at the end of the day, what it all adds up to is that I am qualified to explain the uses and the risks of options, and that's what I plan on doing here today a little bit. Just a quick disclaimer, you know, options trading does involve risk, and it is not suitable for all investors. Past performance is not necessarily indicative of future results, and things that I talk about today may be of my opinion, and of course there would be other people who have their own opinion, maybe contrary to my own. Also, some of the things that I discuss may already be factored into the price. So if I talk negatively about something and the prices have dropped or whatever, that may already be baked into the cake, as they say. So, you know, do temper that with the fact that we don't know how much information has already been factored into the price. Okay, without further ado, there's going to be four basic things that I would like to cover here today with you. One area is going to be on hedging, using options as a defensive hedge against the market decline. Number two is going to be writing or selling options of a short-term out-of-the-money nature on the S&P 500 index options. And then I will try to do a little overview on some of the different commodity areas. And finally, I would like to go over a little bit on things called alternative investments. And alternative investments have to do with investments that are outside the traditional stock, bond, and real estate area. And so basically, I'm going to give you a quick overview on all these things. Again, having not met all of you, and of course, we're in a computer forum here, not a live forum. Nothing here is going to be a recommendation to anyone. It's just information for you to digest. And then, of course, you can determine your own suitability by getting more information. Okay, turning towards hedging, you know, of course, with the market on its all-time highs in many cases or approaching them, you know, obviously people say, why would I need to hedge? But, you know, there are people out there who own stocks like Apple, where we've gone from the 700 range into the 400s. Groupon, obviously, is having trouble here today. The gold shares, you know, obviously have had very large declines over the last year or so. Some stocks like McDonald's, Starbucks, Microsoft have had some difficulty making new highs. Other stocks in the banking area like JP Morgan and Wells Fargo are near their 52-week highs. But then if you look at the stock like Citigroup and you go back 10 years without the or with the adjustment of the split that they did, that's a little bit of a reality check on, you know, the value of some of the banks. So the bottom line is why would you want to hedge? And the reasoning is you're trying to protect something. In this particular strategy that I'm going to talk about, you're trying to protect yourself against a decline. And obviously, the higher you protect that before a drop would occur, the better off you're going to be. But no strategy has all green lights and blue skies. Obviously, there has to be some type of risk to every single strategy. So let's go over that with you very briefly. Of course, I hope you all have a pen and paper handy. And I'm hoping you could write down a theoretical example here so we can give you some kind of a flavor on what hedging is all about using puts and calls. Okay, first of all, in this theoretical example, and when I say theoretical means we're not talking about a specific stock, we call it XYZ, and we are not talking about commissions, fees, bid offers, and all the other factors that come into a trade. Just a basic vanilla theoretical example. In this example, the stock is at $50 a share. You go out and you buy 1,000 shares. So again, without all those other factors, we're going to say 1,000 shares times 50, and we're going to say 50 grand is the value of the shares when you got in. After you get in at 50 grand, it jumps up to 80. So now your 50 grand has jumped up to 80 grand, so obviously you're sitting on a 30 grand to the good. You say to yourself, you know what, I've been to the rodeo before, this thing's had a pretty big move, I wouldn't mind slapping some insurance on this thing in case the wheels come off the bus down the road. So a couple of strategies you could consider. One is called married puts. And when you deal with married puts, you are talking about buying puts against a specific position you have. So in this example, our 1,000 shares that jumped to 80, we're going to go out and buy puts at the 75 level. That's called your striking price. And for this example, theoretical, we're saying it's $500 per option, and we are saying you bought 10 of them. So you're putting up $5,000. Why are you putting up 10 contracts on this? Because with stock options, each contract is 100 shares. So if you have 1,000 shares in this example, as we do, to hedge the 1,000 shares, you're going to need 10 contracts or 10 times 100 shares, right? So in this theoretical example, we're buying 75 puts, and the month that we choose, the expiration date will be the third Friday of that month. So obviously if they were Marches for whatever reason, they'd only have 2 weeks on them from Friday, so they'd go off the board on the 15th. April, third Friday, is the 19th. The March, third Friday, is the 15th, and so on and so forth. So the options expiration is the third Friday of the month for which they're written. Okay? So that's what you've got. You've got 10 contracts going at 75 on the put side, and in this example, they were $500 a throw, so they're $5,000 for 10 of them. Now, when you put up money in life, you're supposed to get something in return. So when you buy 10 puts at striking price 75 and you put up your $5,000, you get the right, but not the obligation, to sell 1,000 shares at 75 until the option goes off the board. Now, what happens between now and the expiration date is an unknown. So let's take it up, down, and sideways and see what that would do to you. Okay, in the first example, again, we bought it at 50, it jumped at 80. So you're 30 grand to the good, but you've taken 5 grand and bought puts at 75. Let's say the $80 stock goes to 90 and the time runs out on the puts. Therefore, you still own the stock, which is now up 40 grand from where you bought in, but you would lose your premium on the put, so you say bye-bye to the 5 grand. That's door number one if it rises to 90. Door number two is it goes sideways. So now we're talking 77, 82, 81, 86, back to 78, basically choppy sideways, but does not go towards 75 or under. Again, you'd remain, and the options expire. Again, you'd remain the holder of the underlying stock, so you still own the stock, but because it never went down under 75 and you never sold the puts out, the options expire worthless and you lose the 5 grand. So door number one is the market rises, you keep the stock but you lose your insurance premium. Door number two is the market goes sideways and you keep the stock but you lose the put premium, the insurance premium. Door number three is really the reason you're doing this, and that's the stock goes back in the tank and goes back to 50. Could that happen? Of course it could happen. Will it happen? Who knows? If it does happen and we are at expiration, your stock is at 50. You have the right to sell at 75, minus the 5 grand you put into the puts, brings your total down to 70. So you have insurance at $70 a share or 70 grand, which protected 20 out of the 30 grand you were up when you put the position on. So if the market goes down, the put comes in handy because you have the right to sell at the higher price well above where you paid in. Now, I think we all know that over time, that strategy would have come in handy during a bunch of different times. But one of the problems is you have to be willing to be balanced of mind that whatever you own may go down. And that's difficult to do sometimes because obviously we get emotionally and financially invested sometimes, and that is difficult to bet against. But you do buy insurance on your home, you do buy insurance on your car, you do buy insurance on many things, And so if you view it that way, then sometimes mentally it's easier to participate in it. And of course, if you've been stung by a big drop in a market or a stock and you have a sizable position, obviously you know from the past that insurance on some of these things sometimes come in quite handy. Now, there is another strategy that is used as a hedge where you use cash flow generated by one side of the trade to pay for the insurance on the other side of the trade. And let me explain that, because that is where the collar strategy comes in. Now here your stock again, and again, theoretical example, not including fees, commissions, or spreads or any other factors, just a theoretical example. The stock goes from 50 to 80, so again, you're up 30 grand on 1,000 shares. You then go out and you sell or write the call options above the market at 85. So your striking price on the sell is going to be 85. On the calls, when you sell things in life, you receive money, unless of course your house is underwater, and then you might pay money. But if you generally sell things in life, you receive money. Now, in this example, I'm saying the calls are going for $600 a throw. We do need a contract per contract, 600. And I'm saying that you're going to do 10 contracts because that will reflect the 1,000 shares that you hold on the underlying instrument. So now you've got 10 contracts sold on the 85 calls. They will expire on whatever month you choose. Again, the third Friday of the month is when they will expire. And you've given you have obligated yourself to deliver stock. Shall the call buyer at 85 call the stock away? So basically, you're agreeing to deliver stock at 85, and you're getting paid $6 for that agreement. Out of the $6 you receive on the calls, what you do is you take 5 of that premium, and you go buy your 75 puts with that money. So in this theoretical example, we've sold the 85 calls for 6, and you bought the puts at 75 with 5 of the 6 that you received. That has created a window for yourself until the options expire. And the window has a ceiling and the window has a floor, right? And so where's your ceiling? Your ceiling is the striking price of 85 plus the dollar you didn't spend, because you only spent 5 out of the 6. So now you've got 85 plus 1, or you've got a ceiling of 86, which is $36,000 higher than your starting point of 50 grand. Now that's going to be your limit. But the reason people do it more than not is the downside hedge. You have the right to sell at 75, and you add $1 to the striking price, because if the market drops and you keep $6 and you only spent you only spent 5, you have 1 extra. So you tack $1 onto your strike 75, and that puts your floor at 76. Now, you've got a ceiling of 86 and a floor of 76 until these things expire. And you started with 50 grand. Now you've put a little certainty into an uncertain investment, because obviously we don't know where the stock's definitely going, but at least you know you've got parameters. Now that's got to feel a little bit better to some of you, or many of you, from time to time, to slap on some parameters than walking around Main Street just hoping against hope that everything will always be well because, maybe Bernanke will print enough money so everyone's a millionaire, or whatever the strategy is. The point being is what? The point is this is a hedging strategy to put some parameters on an investment, to put some parameters in a market. But like anything else, it has a what? It has a use and it has a risk. The opportunity risk is obviously if the stock exceeds $86, you're not making any more money on it. Now you could roll the position up, which is a whole different scenario, which I'm not going to get into right now, but it is something if you had questions on, I'd be more than happy to field afterwards. Or if the market drops, you could always roll the position down as well. The point being is that at least when you initially put it on, when you go to sleep at night, you know what your ceiling and floor is, and for some people, that's a lot more comforting, again, than walking around hoping against hope. So, That is a little bit of an idea on hedging. It's something that I cover at the webinar. It is also something that we cover on our educational DVDs, and we do cover it at greater length. Is there value to that strategy? Absolutely. Is it right for every single person? No. Do you have to investigate other factors that come into play, like your cost basis is and all these other factors? Of course. But it is a strategy that from time to time is quite helpful, and I have seen that there are many people with sizable positions who like that strategy from time to time, because obviously the more sizable position basis your account, the more damage you would do if it did fall apart. And that's why some people like to walk around with some kind of coaster brakes when they're in something that could be a high-speed vehicle. At any rate, it's a strategy that's available, and again, the suitability of it and appropriateness of it will be determined by yourselves and your brokers and whoever you're going through. Okay, I'm going to get into a couple of other things now, if I could. The next area is going to be writing options on the S&P 500. You know, quickly, the stock market, I mean, the transportation average is obviously on fire lately, and it has reached another 52-week high here today, or and also a 10-year high. So this thing has really been moving. UPS obviously has had a big move. It's near its high, but FedEx has had a good size move, but it's still about 15 bucks under its high from 2007. The rails have really had big moves. Norfolk Southern has had a big move, but it's still 10% underneath its 10-year high. But Union Pacific has really moved. It's up about 32% from its 52-week low. So certainly anyone with any kind of vision can see that the transports have been very strong, and Dow theorists would say that that's constructive for the market. So we'll have to see if, in fact, that makes any sense. Writing put options during a rising market may have merit. Now, again, writing options on the S&P 500, if you don't do a credit spread, is not a limited risk option strategy, so obviously it certainly is not right for everybody. However, there are people who do it, and there are people who obviously have pluses and minuses with it. Why would you do it? First of all, you'd use the S&P 500 because you want diversified risk. Obviously, you've got 500 companies involved, so if one company has a problem, it will not have obviously the same effect. It'll have a more diluted effect than if you were in the one share alone, right? Okay, that's one of the reasons they like it. And of course, it is a popular index for hedging and speculation. So generally speaking, getting in and out of it either on the E-mini or on the actual S&P, liquidity-wise, is generally not too bad. That's my opinion. Of course, there'll probably be other people. And certainly during fast market conditions, obviously all bets are off as far as liquidity. But the bottom line is it is a popular index. So again, diversified risk makes it popular. Boom. The what do you call it? The liquidity, getting in and out, makes it somewhat popular. Now, here's some of the keys to it. If you're selling puts in a rising market, you'd like to know where some of the maybe more important low numbers are coming in. So I look at the moving averages. Again, this is all my opinion. There's probably many others out there contrary to my own. But again, the 50-day moving average right now on the S&P is at 1480 area. So that would be an area you'd want to keep an eye on. The average is 1410. In my opinion, one of the more important lows is around the 1330 area, followed by 1275. And you will notice if you do an inventory of the options, particularly on the S&P future, which has a $250 for every point multiplier, so there is more leverage involved, you may notice that some of the put premiums deep out of the money still carry a reasonable premium, particularly with the S&P future. So when you do write these options, a couple things. How far out of the money are you going to sell? How far out in time are you going to sell? These are important factors. And how many contracts basis your equity? How much leverage are you going to use is important to know. Those three right there are very important. That's on your initial entry. Now, like any strategy, how are you getting out of the house if it goes on fire? Well, so there's obviously many ways to do it. One might be if the option that you sold reaches a certain level, you buy it back. The second possible way would be if one of these support levels start breaking and you think that the potential of an accelerated move in the direction against you is possible or increasing in odds, that would be the second way that you might buy them back. Of course, like I say, 1480, 50-day average might be the first warning signal. Breaking under 1410, the 200-day average, would be another warning signal. Obviously, under 1330 and 1275 would be a very loud warning signal. Okay? So there you go. The third way would be you would hold it and grit your teeth until the strike price was reached, because you're going under the concept that as long as time is going by and the the underlying S&P has not reached your strike, that obviously the option is still on its way to zero, because if on expiration day the underlying S&P is above your strike, the option must be at zero because it would have no intrinsic value and no time on it. So those are three basic ways that people try to come out of it. Now, that's all well and good, except if something happens called a fast market, where it's difficult or impossible to buy them back. That is another factor. And of course, the VIX has been very low, between 12 and 20, back and forth, back and forth. Sometimes, not often, but sometimes the VIX can spike up, and then of course the premiums, which were fairly low when you sold them, may have to be bought back at a very high point. Again, these are some of the factors when you're dealing with the writing of the options. And again, many people who've been writing the deep out of the money puts have had some success in the last year or two, because after the corrections that we've seen, the market has been generally trending to the upside. And obviously an uptrending market would take deep out of the money puts with a month or two to go on them, and it would take those premiums down quite a bit, obviously expiring at zero. But again, that's not always the scenario, because that's not always the environment. So that's why you have to be careful. Again, if you don't do a credit spread where you have a corresponding long position, then of course there is not a limit to the risk on this type of strategy. So that's another factor. Now, again, many people do like to investigate more, and at the end of this broadcast, I will announce that there is a webinar coming up where you can learn more about this and other things that I've discussed. So do keep a pen and paper handy so you can write down the date and try to get in on that. With regards to, and again, if it does, if you find yourself buying back a short option position, you can either A, just get out of it and go to the sideline. B, you could consider rolling it down, which means you buy back one option and sell another. Now, the problem with rolling it down is if it keeps going, the next one you sold are going to have to be bought back, and there's double whammy against you, right? The good news is if the market, after you bought back at a loss and you've rolled it down to another option, lower striking price, you might see the market stabilize and rally and recoup some of your money that way. All according how the market unfolds, and all according, if you have the stomach to roll it down after you've already taken a loss on the first one. But the point being is, that is another way of handling this. Now, in addition to doing this on your own, which many of you people may not be suitable to do, or some of you might be. Obviously, I don't know that. You'll have to discuss that with your clearing firm and other people that are involved in your finances, maybe. But there are advisors who do option writing strategies for a living in their accounts. And that's where some of the alternative investments that I was alluding to in the beginning come into play. Meaning, you might say to yourself, you know what, the writing side of the option market is interesting to me because on a statistical probability basis, there are some favorable comparisons in some cases. Obviously, the key is not when the options go to zero, because obviously that's the green light, blue sky side of the trade. The negative, when volatility picks up and you must buy these things back at a loss, how quickly you get out of these things and get out of the ones that are going to cost money is a key. Otherwise, you could end up picking up quarters in front of a railroad coming at you, a train, right? So in other words, you don't want to be picking up small premiums and then get whacked for a big loss because you let the thing go against you significantly, or maybe you didn't let it go, it just went. So that's why how far out of the money you are, how much time you've sold, and what your exit strategy is obviously three very big factors. Now, my point being is, that when you are looking at you do everything on your own. I'm over at Thinkorswim. I'm over at Ameritrade. I'm over at E-Trade. I'm over at what are those Interactive Broker. Wherever you are, you're doing everything on your own. Hey, you maybe find yourself, you know what? I can't do every single thing on my own on every single trade that I might want to do. Not only that, maybe I'm getting spotty results from time to time, and maybe it's time for me to take my amount that I'm working with and diversify it a little bit by investigating some of these advisors or managers who do strategies that I'm interested in, but I don't have the time nor the expertise or whatever to do. And do these guys have a disclosure document which tells me what they're doing? Yes, they do. Does this disclosure document go over their track record as far as what they've made and along the way, how bumpy has been the ride, meaning what is their maximum drawdowns over the period? Yes, they do. And do they go over all the expenses and any costs involved in what they do? Yes, they do. And they outline the uses and the risks of the strategies. So you've got a document that outlines what you're looking at, and it gives you, a complete, more complete information on what you're considering. And then you can say to yourself, you know what, basis all the stuff I'm doing, basis all the things I'm trying to achieve with my money, maybe it wouldn't be such a bad idea to farm out a little bit of money to somebody else who can do it for me, who gets paid with part of his compensation as an incentive to win, and that incentive is suspended if the high water mark comes down until the high water mark is taken out. And that's all in the disclosure document, among other things. And maybe the strategy that is employed, meaning a writing option strategy, might be something that I might want to put a little bit of money in and see how that would go. Now, obviously, past performance is not indicative or necessarily indicative of future results. So obviously, just because the guy's made money in the past, we don't know what the future holds, so you can't extrapolate, returns by looking at the past. But it gives you part of the complete picture of what you're looking at. And then, of course, only time will tell how the ongoing activities will unfold. But at least it gives you hard information for you to take a hard look at. So again, for the alternative investment area, this might not be the worst thing to investigate, and see it maybe for part of your capital, even if you're a self-directed guy. And believe me, I'm very well aware why people like to do things self-directed. Why? Because they want to have control over their decisions. Why? Because maybe they've had a bad situation happen with when they work with a guy. I understand all that. Believe me, this is not my first rodeo. I hear you loud and clear. I also know that it's difficult to do everything on your own with no help at all. And ergo, that's why looking at some of these alternative investments where they have strategies that are not based on the market constantly going higher, maybe that's something to look into. Okay, I'm going to give you a quick overview on some of the different options on the commodity sector, and it's going to be brief because I only got a couple of minutes here. Okay? First thing is we went over the stock market. Obviously, like I say, the markets have been going up and they've been looking great. One of the concerns some people have is historically, when the bond market has had a correction like it did in the last couple of months, where the long bond in the future went from 151 on the top towards 143, sometimes at some point the stocks have reacted to that. Right now that hasn't been the case, but some people do believe that that is a concern. Not only that, obviously, but this sequestration crisis or non-crisis is also a factor. So you got to keep that in mind a bit. With regards to interest rates, while they've eased, lately, as far as yields have come down in the last 48 hours or so, the trend on the 10-year and the 30-year, meaning the 50-day versus the 200-day, have crossed. So the 50-day moving average on yield is higher than the 200-day moving average on yield on both the 10-year and the 30-year instruments. So that's something to consider. Obviously, Bernanke is intimating that the demand for our bonds is great, but it was interesting when the guy said to him, well, if it's so great, Mr. Bernanke, the demand for our U.S. bonds as a safe haven, why is the Fed buying so many? If the world's appetite is so great, why are you buying so many? And of course, he had a little bit of a stumble, and he said, because yields might be a little bit higher if they didn't. They might be a lot higher if they didn't. The U.S. dollar obviously has been firm, so the Aussie and the Canadian, the commodity-based currencies, have been going down. Oil had big run-ups towards 98, backing off. Unleaded gas had a big run-up to 335, backing off. Gold today down sharply. Silver again down sharply. They're definitely on the defensive right now. The GDX is near its 52-week low. The other story is agriculture. Soybeans had a big run last year to 1750, moved back to 1350. Now they're in the 1415 area. If the South American crop does not come in as well as people hope, and although we're looking for a big crop here in the U.S., if it doesn't go out that way, the moving averages are still rising on the monthly graph. So maybe the surprise might be to the upside again this year. Only time will tell. Okay, we are reaching, I think, the end of my section here. I did want to say one last thing, is that on March 13th, we are going to be having a free webinar with the optionprofessor.com, of which I am the content provider. And so if you'd like to go, it's as simple as going to the website, optionprofessor.com. You can see that right on your screen there. And click on registration, and then you'll be and reminded about it as we get closer. We only have space for 200 people at the webinar, so please register if you'd like to get more information. Thank you very much for having me here today. I hope you all picked up a little bit of something. And again, don't forget to investigate more information at your brokerage firms and through all the different accesses you have to options information. And again, I'm Jim. Thank you very much for being with me today.
Great. Thank you, Jim. We appreciate you being here, and as always, appreciate you coming on the Trading Pub and sharing some good education. At this time, I'm going to turn things over to Brad Powell of RightAngleTrading.com. He's going to talk about getting the most out of today's ETF markets. Brad is going to be using the screen sharing feature, so you guys should see his screen display shortly. So Brad, thanks again for being here. If you could, maybe before you get started, just give everybody a quick idea about how you got started in the markets. Thanks.